I think everybody actually wants a weaker dollar. Scott Bessen's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies. I mean, everybody wants a weaker dollar, and the US wants one. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt. I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity. It was all China.
Real Vision founder and CEO Raoul has been talking about the deep correlation between central bank liquidity and the financial markets for a while. In Pal's words, liquidity is the big daddy, the big driver of the financial markets and the entire global economy. He argues that the availability of money and credit in the system, rather than traditional economic indicators like GDP growth or corporate earnings, determines asset prices, economic cycles, and market direction. When central banks and governments inject liquidity through money printing, low interest rates, or fiscal stimulus, asset prices tend to rise. Conversely, when liquidity is withdrawn through tightening measures, markets decline. Powell believes that liquidity conditions override economic fundamentals because financial markets react to changes in money supply before economic data catches up. For example, even in periods of weak economic growth, markets can rally if liquidity is expanding, as seen in 2020 when stocks and crypto surged despite a global recession. He emphasizes that central banks, especially the Federal Reserve, the European Central Bank, and the People's Bank of China, play a crucial role in controlling liquidity through their policies on interest rates, credit availability, and balance sheet expansion. China, in particular, has a significant influence on global liquidity. When China injects liquidity into its economy, it fuels demand for commodities, supports emerging markets, and benefits risk assets worldwide. Powell closely monitors China's monetary policies, as previous periods of Chinese stimulus, such as in 2015 to 2017, have led to broad market rallies. Powell believes we are on the verge of another 2017 moment, with China expected to unleash a torrent of liquidity on the global economy and financial markets. The Real Vision CEO believes this will be the trigger for the next phase of the banana zone, with Bitcoin and crypto asset prices expected to skyrocket wildly. Powell discusses these views in a recent interview with Michael Howell, the CEO of Cross Border Capital. As we bring you clips from the insightful discussion between Powell and Howell, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support, and enjoy the video. Today's video is sponsored by CyberGhost VPN. With over 38 million of users worldwide, this is the most recommended VPN provider on the market, and it has an impressive, near-perfect score on Trustpilot. More than 20,000 rated it excellent on the review platform, so I want to tell you more about this product. A VPN is essential for protecting your digital privacy. And if you think you're already covered because you only browse in incognito mode, think again. Plenty of eyes are watching you every time you go online, and incognito mode only gives you a false sense of privacy. Your internet service provider, your school's or work's IT department, owns your home Wi-Fi router, and even the websites you visit still know who you are and track your every move. To put a stop to this privacy invasion, what you need is CyberGhost VPN. Just turn on CyberGhost VPN before you browse. It encrypts and reroutes 100% of your traffic through their secure servers, so no one will even know about your online activity. It's all really simple, and CyberGhost has servers in over 100 countries ready to cater to your every need. By the way, by changing your location with CyberGhost, you can also unblock libraries of over 40 streaming platforms like Netflix, Amazon Prime, and many more. Just amazing. The app is available for all operating systems and can protect up to 7 devices at the same time for you, keeping you anonymous around the clock. That's a lot of devices, so you can always share your subscription with friends and family. What's more, CyberGhost VPN doesn't keep logs, so not even themselves know what you do online. If you want to keep prying eyes at bay and be anonymous online, now's the perfect time to get CyberGhost VPN. And by using the link in the description, You benefit from an 83% discount, and you also get 4 months for free. And since they have a 45-day money-back guarantee and access to 24/7 customer support, everything is risk-free for you. So, use the link in the description, get CyberGhost VPN, and start protecting your digital life today.
Okay, well, I think we're, as far as I can see, the liquidity cycle is still expanding. I think the issue that we've really got is how much further can it keep going up? Because there are certain clear challenges. And I think the two challenges that really sort of concern me, I suppose, number one is the US. And that really comes back to, I think, two particular dimensions. I mean, one is what the Federal Reserve has been doing, which is this sort of what I've termed sort of secretive or not QE stimulus. And that's kind of fading. And they're going to have to go more explicitly to a sort of a formal QE, although I note that Canada also has done that, but it refused to call it QE. So they said they're restarting balance sheet expansion, but it's, of course, not QE. Of course, they would say that, wouldn't they? And the other issue then for the US is the Treasury, where Janet's been doing this sort of very clever funding trick by funding at the short end, where, you kind of look at the math of that, and it's basically meant that the Treasury has managed to stick in the equivalent in liquidity terms of about $6 trillion of additional stimulus by changing that funding dynamic. Now, that's a huge amount, and that's clearly running off fast, particularly if Scott Bessent is intent on moving back to coupon issuance. So I think you've got those two questions, which are really pertinent ones, and they'll really hinge on what the new administration sort of thinks and says. The other issue, which is maybe gives us near-term concern but long-term salvation, is China, where China is currently seeing extreme debt deflation, where the PBOC has taken a whopping amount of liquidity out of the markets in the last 4 to 6 weeks, trying to hold the yuan up against the rising dollar, and they badly need to monetize big time. Well, I would put the figure of sort of 30% monetization. So China's got to print money big time. America needs to do that, not to the same extent. So we're in a long-term monetary inflation, there's no question. But I'm just pausing because I think there may be a little bit of an air pocket now.
Okay, lots to pick apart from there. So the first thing I'm thinking is obviously we've, breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TGA until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. How do you measure this shorter-term funding dynamic? In what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense, but does it get captured elsewhere? Or do you have to just look at bill issuance in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the tool. But basically what that shows is my estimates of what I call not QE, which is what Jay Powell does, and which is the TGA and things like the rundown of the reverse repos. And you've also got on top of that the other bit that I've called not yield curve control, which is unconventional funding. And that is something like about together, they're adding something like about 6 trillion to stimulus. Now, the way that I've done that is to look at a concept called dollar duration and to look at how dollar duration has changed and put that in liquidity equivalent terms. So that's how I estimate it. And that's really against a normal funding benchmark. The skew has been quite noticeable because as you understand, treasury bill finance has gone up hugely. Bills have been a large proportion of what's funded the deficit in the last 12 months. And on top of that, Janet's skewed the issuance calendar away from long-dated coupons towards shorter-dated ones. And she's taken about a year and a quarter on average out of the average, Treasury auction.
Does that change the debt refi cycle? Or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be short cycles are shortened, and they're going to have to, they're going to have to start pushing a lot more liquidity back more immediately. I mean, that may be the issue. I mean, we know that Scott Bessen's got to fund 30% of the deficit 30% of the outstanding debt this year.
Yeah. And so even if he moves out further duration, the market won't take it without liquidity, whether it's, some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Yeah, exactly. And I think this is the reality, because if they don't add liquidity, who's going to buy this debt, this coupon debt? And we know the structure of the treasury market is itself quite fragile, because, foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, as you will remember, they're fairly fickle, or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem the treasury market could face, a spike up in yields. I mean, we're doing pretty well at the moment, aren't we? I mean, yields have moved up quite smartly anyway.
Howell posits that central banks, particularly the Federal Reserve, are engaging in liquidity-boosting operations that, while not officially labeled as quantitative easing, QE, effectively function in a similar manner. In traditional QE, central banks purchase long-term securities to inject liquidity directly into the financial system, aiming to lower interest rates and stimulate economic activity. However, Howell observes that central banks have been implementing measures that, although not officially designated as QE, have comparable effects on market liquidity. These actions include various lending facilities, adjustments in government cash management, and other monetary tools designed to ensure sufficient liquidity in the financial system. Howell's thesis suggests that by aggregating all sources of liquidity, whether stemming from official QE programs, lending facilities, or other monetary interventions, central banks are continuously influencing financial markets. This ongoing infusion of liquidity can lead to asset price inflation, as seen in rising stock markets and other financial assets, even if the broader economy does not exhibit commensurate growth. This thesis aligns with Powell's everything code thesis and his insistence that central banks will keep propping up their respective economies to avoid any significant downturn. Let's get back to the discussion.
My view on this, I'd like to test the hypothesis, is I think everybody actually wants a weaker dollar. Scott Bessen's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies. I mean, everybody wants a weaker dollar, and the US wants one. But it's fantastic negotiating policy because it's the most powerful throat grip you can possibly have. And so it feels that you get China to play ball in whatever mechanism you've got. And in exchange, you add dollar liquidity into the global system and allow the dollar to weaken. Whether it's, I think the TJ's part of it, but my guess is whether it's swap lines elsewhere, whatever, just to get it into the euro-dollar banking system. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt as stimulus. It needs to do that, but it can't do it without losing control of the yuan for the time being. So if the US will give them cover, kind of what happened last time Trump came in 2017. Right. So I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity. It was all China.
Yeah, I think that's exactly right. And that was also, in a different guise, what happened in the Plaza Accord in 1995. And that was a very similar deal, where the US eased initially, got the dollar down, and then everybody else joined in and started pumping liquidity. And that sort of led up to the 87 crash ultimately, or the Louvre call and the 87 crash. But that was the path. So I think that I've got a lot of sympathy with that. I think that's right. I think the dollar is key. I mean, I agree with you. I think that they need a strong dollar now because it's a great negotiating tool. A longer term, I don't know, but I would suspect they would prefer a firmer dollar than a very weak dollar. But the rest of the world desperately needs a weaker dollar because they're being strangled at the moment. The dollar wrecking ball is definitely swinging. Make no mistake, look at the problems in Europe right now.
Yeah, I mean, the dollar is cyclical. So on a secular basis, because 50% of the world's debts are in dollars, it's going higher because there's always a shortage of dollars. So we get that. Every time liquidity comes out of the system, the dollar goes up.
Yeah.
But at this point in the business cycle, with the ISM survey still low, China in recession, Europe in recession, essentially, they all have to stimulate because in the end, if China picks up, they buy more treasuries.
Yeah.
Yeah. There's the whole financing game, the state of nations that goes on here as well.
Yeah, I think that's right. I mean, I think that there needs to be a deal generally, and that's a US-China deal. And what shape that takes, whether it's focused exclusively on trade or whether it involves some buying of treasuries, I don't know what. But they definitely need to square those circles. And I think, an easy win for Scott Bessent would be to say, get the Europeans, the Japanese, and the Saudis to buy more American treasuries as defense bonds. I mean, I think that's a pretty straightforward thing to do. But how China deals with that, I don't know.
Oh, that's interesting. So Trump's idea of you should be paying for your defense becomes a more direct purchase of treasuries. That's a very interesting idea. And it's very simple. It's very clean.
Yeah.
But I guess a lot of them need to say, well, we need world trade to pick up because we're not earning enough dollars to buy the treasuries, which again is down to this, the dollar needs to weaken argument. So world trade can pick up.
Yeah, absolutely. I mean, and the other thing is, there's going to be talk right now the Japanese are tightening, but in reality, they can't tighten very much. I mean, this is ludicrous. I mean, their debt problems are so big and their economy is pretty weak as well. So, okay, they may make a token gesture, but they can't. They need a bailout as well. So the only solution, as you rightly say, is some sort of US easing. And that may well involve or likely involve some peaking of the dollar.
And, just so people watching this understand why we're talking about all of these is because the dollar is the dominant driver of global liquidity because global liquidity is priced in dollars essentially, right?
Well, I think it's certainly a key factor, yeah. For the reason that a lot of lending, as you rightly say, is dollar-based, so that's key. And then if you look at how central banks run their policies, a lot of them are actually focused on the exchange rates anyway. So if you start to see a very strong dollar, you may well get tightening in offshore economies to try and protect their currencies. Whereas if the dollar is very weak, there's a degree of freedom where people can go along and print money at the same time. So you get a generalized easing. So there's a very asymmetric response in the dollar that a weaker dollar is unambiguously good, whereas a strong dollar is probably not so good.
Don't forget to click on the description link to get the special discount CyberGhost VPN is granting to our channel users. This application will protect your data while you browse and give you full access to all blocked content on the internet for $2.03 a month only. Totally risk-free, so check it out. Link in the description. In other news, popular anonymous Bitcoin analyst Plan B shocked the entire Bitcoin and crypto community after he announced that he had transferred all of his Bitcoin holdings to spot Bitcoin exchange-traded funds. His announcement post reads, "Disclosure, I have transferred my Bitcoin to ETFs. Yes, I know, not your keys, not your coins. But it is just easier for me to manage Bitcoin the same way as equities and bonds. Also, not having to hassle with keys gives me peace of mind. I guess I am not a maxi anymore." As expected, Plan B received a lot of criticism for this decision. When one Twitter user asked him to change his name to Plan ETF, he replied by writing, "I honestly didn't know ETFs were so controversial. In my view, ETFs are a logical step in Bitcoin adoption, next to holding your own keys. Out of curiosity, would it be different in your opinion if I would have bought MicroStrategy instead of ETF, or would that be equally evil?" Though Plan B has been trying to defend his decision, the backlash is expected. Many Bitcoin maximalists dislike Bitcoin ETFs because they believe these products go against the fundamental principles of Bitcoin, decentralization, self-sovereignty, and financial independence. One of their main concerns is that ETFs require Bitcoin to be held by centralized custodians, which contradicts the idea that individuals should control their own private keys. The phrase, "not your keys, not your coins," reflects their belief that owning Bitcoin through an ETF means trusting third parties, which defeats the purpose of a decentralized financial system. Another major concern is the growing influence of Wall Street institutions and traditional financial firms. Bitcoin was created as an alternative to the legacy financial system, but ETFs allow large asset managers like BlackRock and Fidelity to profit from Bitcoin without fully embracing its decentralized ethos. Many maxis fear that this institutionalization of Bitcoin could lead to market manipulation, similar to what has happened with gold ETFs, where more shares are traded than the actual underlying asset exists. This could create a system of paper Bitcoin, reducing its scarcity and suppressing its price. Regulatory risks are also a major issue. With Bitcoin ETFs falling under government oversight, there is a growing fear that regulators could impose restrictions, freeze assets, or even introduce censorship. If most Bitcoin ends up being controlled by a few centralized financial entities, governments could pressure these institutions to enforce compliance measures that limit users' freedom, going against Bitcoin's original vision of being a permissionless and censorship-resistant currency. Maximalists also argue that ETFs discourage real Bitcoin adoption by making it too easy for people to gain exposure to Bitcoin without actually using it. Instead of learning about wallets, private keys, and self-custody, investors might take the path of least resistance by buying ETF shares, keeping them dependent on traditional financial intermediaries. Bitcoin was designed as a peer-to-peer digital cash system, but ETFs introduce middlemen and turn it into just another tradable asset, stripping away its revolutionary potential. Do you agree with Plan B's arguments that ETFs can be effectively and safely used to manage your crypto holdings? Please drop your replies, as well as comments on Raoul and Michael Howell's discussion, in the comments section below. For more videos like this, don't forget to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks for watching.